Hi, this is Damon Pistolka, host of the Faces of Business podcast, where we talk to interesting people about life and business. We cover their backgrounds, obstacles they've encountered, and find out what drives them. Along the way, our guests share nuggets you can use to drive your success. Reach me directly, DAMON at exityourway.us, or check out our website, exityourway.us, for more information. I hope you enjoy our show. All right, everyone. Welcome once again to the Faces of Business. I'm Damon Pistolka, and with me today, I've got Spencer Strickland with me, and we're going to be talking about tax strategies for business owners. Welcome, Spencer. Thanks for being here.
Thanks, Damon. It's great.
Yeah, awesome. Well, it's great to have you. So, first of all, Spencer, I forgot to mention the name of your company in the intro.
So, the name's it's GrantStrickland.
Okay.
You know, I get a lot of people asking me, okay, is your name GrantStrickland? I mean, no, it's my partner is Shane Grant, and I'm the Strickland in that. So
okay, awesome. Well, you know, so for some people, taxes might not be something they like to talk about. I know nobody likes to pay them, but I think it is an interesting subject, especially when you're talking about business owners, high net worth people, or business owners going through transactions. It's something that you know, in our company, we get involved with a lot. Not that we decide what to do. We just say, hey, find the right people, because it can make a huge difference in how much taxes you have to pay.
Yeah.
And that's how we get it. But let's back up a bit. So Spencer, give us a little bit about your background and you know, where you started out, and kind of, you know, how you just kind of got to what you're doing today.
Okay. Yeah. So, background, I originally was going to, Damon, I probably haven't shared this with you. I was going to law school.
Oh, wow.
An attorney.
Cool.
And figured, as I was going through that process, I saw that I didn't really like just pure law. I also did a lot of accounting, and I was lucky enough to start working with a local CPA firm, and did some taxes and such, and did some consulting, and I really enjoyed it. And so it took me a little bit longer to get through school because I had to change up a lot of stuff, but switched over and started doing taxes instead. Got my master's in accounting and went on and got the CPA, and I've gone from there. Started out my career with Deloitte, one of the big four firms.
Yeah.
I think you're aware of that. Worked with a local firm in Salt Lake City for about 8 or 9 years.
Mm-hmm.
We were merged into BDO, which is the 5th largest accounting firm, around 5 years ago, and then just under a year ago, started my own practice.
Okay, so you've had, I mean, with Deloitte and then the local firm moving into BDO, you've done some pretty large firm accounting work.
Oh, I've honestly done it all. I've worked on clients that have over 10 billion in revenue and market caps in the billions, and I've done your startup companies that are pre-revenue and trying to raise capital.
Yeah.
It's a fun process.
So this is just kind of off topic a little bit, but when you have these huge companies, are there like literally just like groups of people that work on one little section of the business, and then groups of people that work on another? You almost have to break it down into this business unit or this business unit kind of thing.
Yeah, that's spot on. Even when I was with Deloitte, we had a whole team that would work on one section of their tax return. And,
oh, really?
Yeah, I mean, they're very complicated and complex. So yeah, you've got those teams and those groups or divisions that's what they're doing in each business. So
because I never thought about it, because in the long form, I mean, you could just take a schedule, and that's what the team works on, are those schedules for big companies.
Oh,
okay. Yeah. when you think about it, you think about it in a production kind of process like that, in a very big, I mean, because a multi-billion-dollar company doesn't just have one business usually, and there's different operating units and all this
Yeah,
kind of stuff. There's a lot of different things that come to play in that. Huh?
yeah. You have all that that usually consolidates up, right?
Yeah.
Yeah. It's,
Wow.
it,
Wow.
it can get very crazy sometimes.
Yeah. Yeah. So so if you had to go back and look at some of that experience, what are some of the things you think you really took away from that kind of thing that helps you today?
I think the biggest thing is that you got every situation. Or let me state this: a lot of situations have many things in common, but every situation is unique.
Hmm.
Every taxpayer client, if you will, is unique in their strategy that they want to take, in their risks that they're willing to take. And so you can't just approach from a high level and say, hey, this is my blanket way of doing work. You've got to do everything based on the facts and the circumstances and the approach and goals of the people that you're working with.
Yeah. So that brings me to something else that may or may not be relevant. But so, have you ever had somebody just come to you and say, "I don't care the risk. I don't want to pay any taxes"?
Yeah, I have multiple times.
Because I mean, it is a strategy, right? It is a strategy, and
That is a strategy, and typically at that point, you walk through everything with them, and you see the circumstances. Because you know what, there are certain times when that person, I'm like, yeah, I can get you there. But for the
yeah.
most part, let's say for the most part, I'm like, yeah, I can't legally get you there. And if you're wanting to do something illegal, I just won't work with you.
Mm. Yeah, I'm just trying to say is go as gray as you
Yeah.
can without going outside the
Oh
line,
yeah, yeah.
'cause
We do that.
yeah, because there's some people it's like, nope, don't even want to go there, don't even want to take that, I don't want to deduct that, even though I could, kind of thing, and
Mhm.
everybody would. But to the other side of it is like I deduct everything plus this, plus that, and you're going, ooh, that's kind of that's
It's a little
it's
risky, right?
yeah, yeah.
Yeah.
So, and I understand the willingness and to minimize that, but that at a certain point, you got to believe that it's not worth it.
There are many points where it's not worth it, right?
Yeah,
Um, yeah, especially, I mean, I'm sure everybody's seen the news stories of people who've gone to jail because of tax fraud or tax evasion. Yeah, they've done something that's not worth it at that point, right?
yeah,
So,
yeah, yeah. That's when you get to that point. I think that's far too far. That's for sure.
yeah,
So,
definitely.
so what has been something over the years of doing taxes that really has surprised you?
Oh, there's been a lot of things that have surprised me over the years doing taxes. I will say this: you mentioned at the very beginning of the call, hey, nobody likes paying taxes. I've had, and like isn't the right term, but I've had one person in my entire career who actually wanted to pay tax. Like they were fine with it. They were grateful that they were paying tax.
Yeah,
Every other person I've ever talked to, and that includes myself, you know
yeah.
what? I feel like I pay more than my fair share of tax. I think most people feel like they pay more than their fair share of tax. And so the goal is to get your taxes as low as possible.
Yeah. Yeah.
But to answer the surprise, yeah, I was surprised to find one person who was,
It's like, yeah, I'm cool with it. I want to pay my taxes.
yeah,
I'm glad I have to. And I can understand that too, because if you have to pay a lot of taxes, hopefully you've made a lot of money and it's not such a bad deal, right?
yeah,
And you get to that point and that's a lot. It's not quite as different of a decision as it is on the other end. That's for sure. Um, so when you think about taxes and what you're doing, you have some things that you talk about, um, your vision of taxes, and what do you what's just your overall philosophy towards taxes and what you're trying to help people do?
well, so I think in just like any other thing, you've got a plan for it. Um, if you don't plan for it, you're going to end up paying the highest amount, right?
Yep.
I have an analogy that I use, Damon. I like to camp, and so this is a good analogy for me. There might be people who hate camping, so it's a horrible one. But I look at it this way, if you're going to do a camp out, you got to plan for it. If you don't, it's going to be horrible.
Yeah.
But depending on what you're going to do, depends on how much planning you need to do. If it's just me, and actually, let me go back. I've got a buddy who he loves to camp, and he just gets in his car and he drives up into the mountains, and he has a sleeping bag and a tarp, and he'll get up in the mountains. He hikes up to the place that he wants to camp, puts the tarp down, puts the sleeping bag down, and camps there. And he'll spend the next day hiking, and then he goes home. Not a lot of planning into that. Okay, it's just him. However, with me, I'll usually go camping with my wife and maybe my kids. There's a little more planning that needs to go into that, right?
Yeah.
I've got to figure out, hey, what are we going to eat? What are we going to bring with us? How are we going to cook, right? And then I'll give you another example. This last year, I did a whole family, like my extended family. We did this huge camping trip, tons of planning that had to go into that, right? And then I'll even throw in, hey, if someone's bringing, I do a tent most of the time, but if you've got an RV, hey, there's even more planning around that, right? You don't want to run out of fuel. I've actually had someone who ran out of fuel while they were doing that. But the point is the same with taxes. You have different levels, and that's sort of my philosophy. You have different levels. If I'm an individual person, have a W-2 wage coming in. There's not a lot of planning that can be done, and there's not a lot that you really need to do, but you still should be looking at it at least, just on an annual basis. If I've got W-2 or I've got a business involved, hey, I'm a little bit more complex. My plan needs to be a little more complex. If I've got multiple businesses involved, it needs to be even more complex, and it can just keep growing and growing and growing as far as what your plan needs to be in order to get you to where you want to be from a goals perspective. Okay. That's how and I always try and start it out with, hey, what's your goal? What do you want to do? If the answer to that goal is, hey, I don't want to pay any tax, well, let's figure out what the real goal is there.
Yeah.
But
because you're trying to, most of them, it makes a lot of sense. And it is a great analogy, because if you look at that and understand, and when you have multiple businesses, income going between multiple businesses, or and just how the owner takes compensation or doesn't, or there's just a lot of that, and the ownership structures in them and how that affects it, and sometimes even with other corporations owning part of it too, it just can add to the complexity an awful lot. So interesting. So if you were out there looking, what were let's just play it for example. I'll just back up a little bit. If I'm sitting here today and I'm a high net worth or a business owner, and I'm sitting here, what are some of the questions I should be asking my tax person every year? Because that's the thing that I always wonder, is what we really should be talking to them about.
Well, honestly, I think the number one thing you really want to do, and I say this, Damon, because I see so many people who they don't plan. Okay. Mm-hmm. The number one thing you want to do is go to your tax professional and say, hey, I'd like to sit down and talk about what I can do to minimize my taxes. And then you sit down and you talk to them, right? And for lack of a better way of saying this, when you're in that meeting with them, you're asking, well, what are some ideas that I can do? Generally, they should be able to come up with certain things that you should be doing. Okay. Mm-hmm. And I'll be honest, even in my case, there are times when I sit down with someone and we go over their taxes, and like I look at a prior year tax return to see what's done, and I'll ask them a bunch of questions, and I'll say, are you doing this? Are you doing this? Are you doing this? And the answer could be yes to all of them. And so my answer as a tax professional may be, you know what, you're doing everything you can based on your circumstances right now.
Yeah.
Common ones, if you're just if you're a W-2 employee, that's all you got. Okay. Tax planning strategy. Make sure you're contributing to a retirement plan if available. If you've got a high deductible health insurance plan. Make sure you're contributing to your HSA or your company's contributing to your HSA. If you're, there's strategies that you'd want to go over around your itemized deductions versus standard deductions and things like that. But from an individual standpoint, if you're in a business, if you've got a business, you should be going in and asking, hey, can I deduct this? Or the question is, hey, what am I not deducting that I can?
Yeah.
To do that, your tax professional needs to have access to what you have been deducting or what your accounting looks like. But those are the typical things that I would go in and ask. And honestly, you got to ask almost that same question or same questions every year, because tax law constantly changes. I mean, we have a proposal out right now that is going to change a significant amount of tax law. And as that changes, there are certain deductions you previously could take that you can't. And there are deductions now that maybe you can take that you previously couldn't.
Yeah, that's good. It's good. I think you're right. I wouldn't know that you're right, but it seems reasonable what you're saying is going and asking every year, because the tax laws are always changing. That's for sure.
Yeah.
And so what we should be asking, and then there are some things that we should be doing as well. And that is primarily, first, we should be going in and asking the tax people what are some things. Are there other things we should do? And are there specific places where we should be researching some things, or where are some places just to understand generally what's going on?
So, Damon, I'm going to twist that a little bit. I want to say what you shouldn't do.
Okay.
And when I say shouldn't, like take it for a grain of salt, if you will.
Yeah.
I have a lot of people who reach out to me and says, hey, watch this video. And it's a YouTube video.
Yeah.
And someone's pitching a tax strategy.
Yeah.
And I'll watch it. And you know what? Generally, there is some truth in those. And there's some good strategy in there. But I would say I've yet to see one where there was something that wasn't completely wrong that just made it way overblown. They were overselling the strategy to where it did not have the effect that they wanted.
Yeah.
And so my point to that is, don't just trust YouTube. I think most of us, hey, just because it's on the internet doesn't mean it's true, right?
Yeah, that's true. That is the case. That is the case.
But that being said, I appreciate it when my clients will send me those videos, because then I know they're actually looking for opportunities and they're not just being lazy about their own tax situation.
Yeah.
And there have been, if I'm completely honest, there have been times when I've seen some of those videos and there was a unique issue. Now, it still wasn't completely correct, but I was able to, as a tax professional, go back and research into it and say, you know what, this is something I did not know before. And that really, if I jump back, when you're talking to your tax professional and you ask them a question like this, and you're saying, hey, I saw this strategy, and they generally, and this is any professional in my mind, not just tax professional, if you're talking to an attorney, if you're talking to a financial planner, you ask them a question in relation to something that you've heard about. They should either answer it in one or two ways. They should say, oh, I know all about that. Here's some issues around it. Or, well, I don't know a lot around that. Let me look into it and I'll get back to you. What I don't like to hear, and I hear this way too often from various professionals, is, yeah, I don't know anything about that. We can't do anything. I don't get that answer, obviously. But as you're asking those questions, to your tax professional, and just your question on where you can research from a tax perspective, I think the best places are, I love irs.gov. It's gotten a lot better over the years, a lot more robust. If you're reading through anything on irs.gov, generally you can trust it. Now, the IRS straight out says just because it's on our website doesn't mean you can rely on it.
Yeah.
I find that a little odd. But it is a great research tool, if you will. Okay.
Yeah.
And the other thing, I love this and I hate it. It's the same as the videos. It's when someone comes into me and they say, hey, my friend's doing this. Right. And I'm like, well, that doesn't mean they're doing something right. But I still love that people are coming to me and talking to me about it, because I want to get them educated on what they can and cannot do in their situation.
Yeah, because every situation is going to be unique, as you said, and
It really is.
It is. So you can't, just because your friend or your neighbor's doing it or something like that, it can be a completely different situation.
Yeah. Damon, can I give you an example of that really quick?
Yeah, that'd be good.
I've had this happen multiple times. Client comes in and says, my buddy is writing off his boat in his business. How do I want to buy a boat? I want to write that off of my business. Well, the thing they don't know, and I'll right out say this, there are taxpayers who out there, they write off their boats, and they shouldn't. There is an IRS publication, as well as what's called a revenue ruling, that it straight says you are prohibited from writing off any boat or watercraft.
Okay.
Unless you are in the business of dealing or leasing boats, if you will. And so many times, hey, that person is actually leasing out their boat. That's how they're writing it off. They have a business for doing that. You can't necessarily, me and my accounting practice, I'd love it if I could go out and buy a boat, plaster my name across the bow of the boat, and I can deduct it in my business. I could do that, and I'm playing an audit game, right?
Yeah.
I'm waiting to see if the IRS comes and audits me. But under the laws, no, I can't do that.
Yeah. Huh. That's interesting. Well, I think you're right. It's like some of the things you can do, and you may get away with it for a while, but you may end up paying for it later.
Yeah.
Yeah. And that is a great example, because I'm pretty sure I've heard that myself.
Well, everybody wants to do it.
Yeah.
Yeah. And Damon, I've said this to you before, and I'm sure a lot of people on here have heard this. There's the saying, pigs get fat, hogs get slaughtered.
Yeah.
Right? Pigs are the general thing around that is, hey, do the little things here and there, do the things that are within that, and you're going to continue to save money on taxes and grow your wealth. If you're being super aggressive, eventually you're going to get caught and you're going to get in trouble. So.
Yeah, that's for sure. So we're heading into the end of the year. You got a new president in office this year. Yeah. And we started off earlier this year with talking about taxes changing, capital gains were going to change. I always hear that a lot in our business about capital gains. We were at, what is it, just shy of 20% or something like that on capital gains. And there was, first thing it came out, it was like going to be close to 40%. So what are some of the things that you're seeing coming out of the different committees or the House or the Senate that, gives us an indication of what's going to be happening with our taxes for 2022 and beyond?
Yeah. Okay. This is the perfect question for right now, because the House and Ways and Means Committee just released their proposal on a tax bill. I believe it was on the 14th.
Okay.
Actually. Anyway, they released it, and it's been thrown out there under various plans that they want to raise capital gains to 40%. Underneath this bill that was passed, they're proposing a 25% top capital gains rate. So you'd still have, right now, you have a 15% rate that goes up to a 20% rate when you reach certain thresholds. And this would just, once you reach even a higher threshold, it'd be 25%.
Okay.
Okay. Along with that, you currently have what's called it's a Medicare surtax, 3.8% on anything above 400,000 in income. So your top capital gain rate could end up being 28.8%.
Okay.
Okay. The other thing that a lot of people are looking at are those individual rates. Right now, your top individual rate is 37%. It's proposed to go up to 39.6. 39.6 is the rate it was before the Trump tax cuts that passed a few years ago. Okay. And then the corporate rate right now, corporate rate is currently at 21%. It's a flat corporate rate. Under the proposal that's out there right now, they would raise it to 26.5%. I don't know why they love throwing in this 0.5%, like 26%. Or even the 21%. Why can't we just do 20%?
Yeah.
I like even numbers. The 26.5%, just so you're aware, only applies to businesses that have taxable income in excess of $5 million.
Okay.
So everything up to 5 million would be at 21%. Everything above 5 million would be 26.5. The other thing that is a little, in my mind, concerning is that 3.8% that I talked about for capital gains, that additional amount if you make more than 400,000. Typically, that's only on investment income. So interest, dividends, capital gains. Congress, or in this bill, if it was passed as is, it would include that 3.8% on anybody. If you have ownership in an S corporation or partnership, your earnings coming out of that, even if you're active in it, would have to still be subject to that additional 3.8% tax. It's a little concerning because it's called an investment income tax, and I feel like if you're working in your business, it's not really income. So that's why it's concerning to me.
And so when you look at that, would that, so that's like on the draws and such that you would be taken out.
Effectively on your draws. Now, again, that's if you're making more, if you're single and you're making 400,000 or more, and if you're married, it's 500. Married filing joint would be 500,000 or more.
Okay.
Well, the last one that's on a lot of people's minds, Damon, are estate and gift tax right now.
That's a big one.
Up to, I can get, each spouse can give almost $11.8 million without paying any tax on it. If they die, they can give it away. If they give it away throughout their life, they can give it away to their heirs, like kids and grandkids and such throughout their life.
That's an in total amount, or is that per child, or is
that's an in total?
Okay. Yeah.
What they're looking at, what the proposal would be, is to reduce it down to 6 million, so almost in half. Effectively, what this is saying is, hey, if you're worth more than $6 million, you're wealthy and you deserve to pay a tax on that if you pass, or if you want to give away more than that. This is creating I've had, since this came out last week, I've had multiple calls because you got people who are worth $12 million and they're like, hey, I didn't really need to do anything. I need to do something now before this potentially passes, right? Again, that's if you're married, it's per spouse. So even if you were married and you were worth 12 million between the two of you, you could still give away effectively 12 million tax free.
Okay.
But again, these are just proposals that are out there. I'll give my opinion on, some of these are going to pass, or I think that they will pass. Others, I think they're going to get kicked out. I really don't think, or I'm hoping that 3.8% on your S corp draws and your partnership draws, if you will, I'm hoping that doesn't pass. I do think that you're going to see an increase in corporate tax. It may not be to the 26.5, maybe it's to 25%, but I do think it's going to go up. I do also think that they're going to raise that individual rate. There is just so I can throw something out there, based on some analysis that's been done. If you were in the top tax bracket on all of these, you would effectively pay, just for federal taxes, 46.4% of your income, not including state. So if you were in California and their top tax bracket is 13%, you're well over half of your income's going to taxes.
That's a bit more.
There are also some other incentives that are being proposed. There's not a lot of detail that's been released, especially related to electric vehicles.
That's funny how the increases get them out there right away, but anything you can do to mitigate it, that's going to take us a while to figure those out. I wonder if that's magically happens like that.
Well, it's in the bill, and to be honest, I have not read all 1,000 pages of the bill.
Exactly.
It's just people are more focusing on, hey, oh my gosh, we're gonna have to pay this additional tax. What can we do about it?
So what are some of the interesting things that you see in the world of taxes beyond, the things? I mean, what are some of the ways? I'll just rephrase my question a little bit. So if you're sitting out here today, you're a high net worth individual, say, man, I might have to pay $500,000 a year in taxes. What are some of the things that you should be doing that you might not be thinking of now?
Okay. Number one, and then let's just assume this is a high wealth individual, that they're only getting paid wages. It's not from a business.
Yep.
Is that right?
Because that actually came up with me and someone. I was talking with a financial advisor about this, and they deal with higher net worth people, and they were saying, I love sports people, but the one thing about it is they have huge salaries, but it's all W-2 income.
Yeah.
Most of their income is W-2 income. So this is a great example.
Yeah. So some things that you can do, and it usually involves investing, right, in some way or another. Okay. Well, actually, let me back up. The number one thing I would say, if you're charitably minded, is maximize your charitable deductions or contributions. If you're a high net worth individual and you're giving to charity on an annual basis, use it's called a donor advised fund. Every large bank or brokerage will have a donor advised fund that you can contribute to. And effectively what it does is, let's say I'm giving $100,000 a year to charity. Okay? Well, I can, instead of doing that on an annual basis, I could say, well, I've got the cash and I want the deduction. I want to put $1 million into this donor advised fund. And if I'm doing that much, I'm assuming I'm in the tax bracket. So if I do $1 million, I'm going to save $370,000 in taxes at that point. And then over the years, when you put it into that donor advised fund, it is a charitable contribution. It is a 501c3 charity, but you get to direct how those funds are used. That's why it's called donor advised. You've made the donation, but you advise on how it's used. I've done this myself in the past, where I sort of just wanted to double up my deductions for the year. And I put more in there. And then over the next 3 years, I paid out my various charitable intents out of that donor advised fund. So some went to, let's say, Make-A-Wish or United Way, or my church, or almost any recognized charity. You take it out of there and you send it to the charity. And it's just a great way of doubling it up for that year. Right. That'd probably be number one. It's easy, low picking fruit right there. Okay. The second one that I would sort of talk about is just various investment vehicles. Now, these you have to really research and make sure it's a good investment opportunity. And I state this because I don't want you to spend $100 and save $37 in taxes, but then you never get your $100 back.
Yeah.
Right. And let me just throw out there, so right now, you can go out and you can buy into various solar companies, if you will, or the solar panel investment companies. Let's just use $100,000. If I put $100,000 into one, that solar company is then using that money to install solar panels on buildings, and then you get a credit for that of 26%. So you get a $26,000 credit. Okay, so you save $26,000 in taxes. Over time, wherever you install those, you should be getting a cash flow as well, a return on investment, from effectively the sale of the power those solar panels are generating. So you should get your money back. Where I say, hey, look into the company, look into what they're doing, is to make sure or have a reasonable assumption that you're actually going to get the money back. I've seen it way too many times. I've had clients that have done these types of strategies, not with the solar. I haven't seen this happen yet with that, but I'm assuming it will eventually, where they'll put the $100,000 in, they get that big, huge tax benefit. And then later on, a couple of years on, the company that was marketing it goes bankrupt, and they never get any money back. And so, oh yeah, I got a huge tax benefit, but I'm out this $100,000.
Yeah.
And these are all just as individuals, right? Because there's limits to what you really can do as an individual. There are a few. There's one other one. I don't want to talk about it because it's one of those that's on the chopping block with the proposals, so it doesn't make sense to do it right now. Love to talk about it if it comes off.
Yeah.
But it's one where huge benefit, and that's why it's on the chopping block, if you will.
Yeah. Okay. Well, there's just some good ones, and I think that it's interesting to be able to really think of taxes in a proactive manner rather than reactively, just because of the fact that you can make a difference. You can make a difference.
Yeah.
And when we look at some of the things that people can do to mitigate the capital gains and over a long-term period, there's a lot of things in that. I know in the other annual earnings and the stuff like you're helping people with too in the annual space, there are things to do too. And it's just good to hear that, yeah, you're not going to go to zero, probably if you're making money, but there are ways to make it as reasonable as you can get it.
Yeah.
Yeah.
Yeah. And Damon, if you've got a business involved, that's really, that's where you need at least, and I mean at least once a year, you need to be sitting down with your tax professional and going over it.
Yeah.
If that's the case, I recommend October, November, December timeframe. I prefer to sit down on a quarterly, sometimes monthly basis, just to say, hey, here's where we're at. Okay.
Mm-hmm.
And sorry, you brought up capital gains, so I want to hit this. If you have capital gains, like I met with a client yesterday, and they recently sold a rental property that they had in California. Smart time to probably sell.
Yeah.
I don't know if it's smart to sell or not, but values are pretty high.
Yeah.
So they have a huge capital gain. Well, the first thing I ask them is like, okay, you've got a stock portfolio. I know it's not likely, but do you have any stocks that are running a loss right now? Do we want to sell those so we can loss harvest to offset this gain? So I'd always say if you looking at that, you've got capital gains. I don't care if it's on stocks, sales of real estate, sales of virtual currencies like Bitcoin, and then you've got other things that are running a loss. Sell those off so you can recognize the loss. One caution is you can't sell off a stock that you have a loss on and buy it back within 30 days.
Yeah.
That's under the wash sale rules. But as long as you don't rebuy that stock for 30 days, you can recognize that loss to offset the other gains.
Yeah. That's a good suggestion, because it could make a significant difference. Because if you got some of your positions in your investments that are upside down by a long ways, getting out, taking the tax advantage of it might be a really good thing to do.
Yeah.
Yeah.
And even I'll be honest, I've got clients right. Today's markets are doing generally really well, but you still have various stocks that aren't.
Mm-hmm.
And so I've got clients who they might have $100,000 gain, and then they've got $100,000 loss on a stock that we're like, hey, let's sell that off. It's not performing. It's not going to perform based on all of our analysis. Okay. And going along with that, Damon, this is the other thing I'd say. Get all your professionals involved if you can. And just depending again how complex your situation is, if you've got someone who's managing your wealth, like a financial advisor, and you've got a CPA or a tax professional, get them in a room together or on a Zoom call together, if you will, to discuss all this, because they're going to all have their same, or they're going to have different ideas, and they're going to get you hopefully to the best place you can be.
That is a really good point, because I think a lot of people, significantly net worth people, fail to do that. They just go to one person or a firm, and that's what they do. They don't get the other people involved.
Yeah. Well, and Damon, I'll tell you, this got drilled into my head probably a little over 5 years ago, when I had put together what I thought was a bulletproof plan for my client. Okay. And to be honest, there's nothing that's bulletproof. Let's just get that off the table.
Yeah.
It was a good plan. It was really good. What I didn't know was and we didn't execute the plan yet, luckily. But what I didn't know is they had been meeting with their attorney, and the attorney was putting together a plan in a separate area. But if we went through with either one of ours, it completely conflicted. Okay.
Mm-hmm.
I was doing some income tax planning. The attorney was doing some estate planning. Okay. If we would have implemented the income tax planning, it would have really messed up the estate planning, and the same vice versa. Luckily, we found out about each other before either one of us executed.
Mm-hmm.
And we're able to put together and sort of reconcile the two different plans and get them together. So we got to where we wanted to be. But since then, Yeah, I will always ask my clients if they're coming to me and we're doing planning. I was like, hey, what are you talking to your financial advisor about? What are you talking to your attorney about? Can we get on the phone with them as well to make sure that whatever we do here doesn't mess up something else?
Yeah. Well, and I think that, I mean, as things change, and this is the other thing that we see in business and with business owners is that, the changes for someone who's living the life um, happens over time. But if you don't make the changes, like, so you'll see someone that has had a business for maybe a lot of years and they use the same attorney forever, right? And they don't understand that I'm not that startup business or that $2 million business. I'm a $40 million business now. And I'm still doing my taxes, which may be appropriate, but maybe not. I'm still having my lawyer that was helping me at a $2 million business do my same work because I like them and at a 40. No, I'm not saying there's anything wrong with that, but it takes more people to coordinate what you're going to do if you're going to do it right as things change. And I don't think that a lot of people recognize that and go, hey, is it time for me to augment what I'm doing in the financial and tax areas of their lives enough? And I think you're bringing up a great point, that you need to get your team together and talk about it at when it's a certain point in your life, because it can make a huge difference. And like you said, if you executed that same thing, it would have negated the benefits of either one, plus the lost time, all the pain in the butt that you had to deal with, because of it, and really could cost a lot of money going on like that. Wow, that's so relevant. And it's funny how much that crosses over into one of the first conversations we have with business owners if they come to us and say, "Listen, I'm thinking about selling my business." And the next question that we ask is, "Have you talked to your financial advisor about it? Do you understand what the tax implications are? And do you know if this is going to be enough money for you with the business at the value today?" Because there's so many things that need to cross through that high net worth people, business owners, whatever, they're used to making the money. They're used to having a business that's supporting them. And these are very different things. And taxes is like that. I mean, you do it every year, but it changes as the businesses change and your lifestyle, life changes and all that. So
Yeah.
interesting.
And Damon, just going on with if you're out there thinking of selling a business, this is my approach. Okay. I think before you go out to market, what you want to do is you want to say, and you're not trying to establish a market value of the company. You want to get with your financial planner, your CPA, your in-house accountant if you need to, your attorney, and calculate out, hey, well, here's what I'm spending right now. Here's my spend per year.
Yeah.
Okay. And then you back into, and you back into, here's what I need the company to sell for in order to continue to spend what I'm doing. And I'll be honest with you, most of the time the company's worth more, and you're more than what you need. Because then you take that number. So let's say that number is what you need for the rest of life, so that you can just put into a conservative portfolio, if you will.
Yeah.
And let's say that number's 10 million. Most of the time I'm seeing the company, hey, it's still worth like 20 million. So well in excess. And that's, and you got to make sure that you're talking about after-tax dollars too, by the way. Just because my company's worth 20 million,
out the door dollars, net to
out
you.
the door dollars, not what I'm going to sell for, right?
Yeah.
Okay. That's how I like to approach it, because you know what? If you don't, you might run out of money. And the hardest part about that, especially with business owners, is you have a lot of what I call quasi personal expenses. They're legitimate business expenses that you're writing off.
Yeah.
But once you sell the business, you're probably going to continue to spend that money. A good example of that is anything related to travel. Because generally, at least the way I run it, if you're traveling in your life, I can get you to where you can get that as a business deduction. I mean, unless you're going somewhere really extravagant, has no business purpose whatsoever, and that can be a significant cost. But yeah, you need to approach it that way. I remember what I was going to bring up. This was more than 10 years ago. A client who sold their business, very cash flow. It was a cash cow.
Yeah.
Okay. They sold it. They did not realize how much they were spending. I was not involved with them at the
Yeah.
time, but they literally were out of money in the next 10 years.
Yeah.
They ran out of money because they didn't realize how much they were spending.
Mm-hmm. Well, it is a critical thing to know. Even if even if gut instinct tells you there's no way I could ever spend this money the rest of my life. I mean, you really need to understand that, because it is pretty amazing when you look at what $20 million sale of a business turns into in the end, when you compare that to somebody's lifestyle expectations and everything else. When you take away something like a business that is generating cash flow on a monthly basis, daily basis, whatever you want to do, and you go, okay, now I have to have an asset that generates that cash flow at a return basis, and it might take a lot. It takes a bit more money than you'd expect.
Yeah.
But that's great advice, I think, and it's something. It's like you said in that example, 10 years out of money. You don't want to find it out 10 years. 10 years in that you don't, that, my trips to Europe aren't going to be there anymore, or whatever it is. Because let's be honest, high net worth individuals. I mean, some people have multiple homes. They have, dozen cars. They travel 4 months out of the year. I mean, all this kind of stuff that when you look at it, your lifestyle, you really got to look at that after whatever you're doing lifestyle to understand, because it can be significant.
Yeah. It can be real. Yeah. It can be really significant.
Yeah. Yeah. And yeah, it's not the norm, obviously, but it is. And that's what I really, and like in the example you gave of the people that had a nice cash flow in business, it's significant and you don't even know it, because it's 20 years of doing it, 30 years of doing whatever it is, then that just becomes normal habit.
Yeah.
Well, don't think of it anymore.
Even this is just, I feel like human nature. Like these clients, they started spending even more because they weren't working in the business anymore.
Yeah.
They didn't have anything else to do, so they spent. In fact, that's something people always ask me. I'm still a young guy, but they still say, "Hey, when's your retirement? When do you want to retire?" I'm like, I don't want to retire. I love what I do, and plus, I'd rather make money than spend money.
Yeah.
So.
Yeah. Well, I mean, you bring a very, very valid point, and it's one of the psychological and fundamental things that I think when people are getting ready to retire, B, sell a business, as I'm dealing with clients, it's what is the next step? Because the next step, if it's just going to be, oh, I'm going to play golf, can't play golf 24/7, 365. You're going to go crazy. If you're a high driven individual, that ain't going to work for you. There's a few more planning steps involved in that. Otherwise, it does turn into more spending on things that were unplanned. And if you plan it ahead of time, you can plan for that spending to actually know what you're going to need to do. Because on the other side of that, there's a lot of people that go into another phase in their life, whether it's they start a different business, they do more philanthropic efforts. There's just so many good things that you see from it too, when it's planned and executed properly.
Yeah. And Damon, I'm sure you've seen this in your practice as well, but I'd say almost half of what I do when I'm talking to a client who's selling their business is talking through those. What are you going to do?
Mm-hmm.
Including you're talking about, hey, what are we spending money on? What else do you want to do? What do you do? Especially if they're younger.
Mm-hmm.
I've got a client right now who they're in a sales process. She's 31.
Yeah.
And I'm like, okay, what are you going to do? You have a long time left.
Yeah.
That's really what it is. And you got to figure that out, because you don't want to get into this funk of either spending money or more often than not. A lot of people go into depression when they don't have purpose anymore. Right?
Yeah. Yep. Figuring that out. And it's cool to hear that you love your work so much that you're like, hey, I could keep working. And I think that a lot. I mean, I'm going to work well into my older age as long as I can do it. And I can see myself changing, I may not work as intensely for the number of hours, 7 days a week kind of stuff when it needs it anymore. But it really is. It keeps your mind active, keeps other things going. And I think that is really that part of that as people sell their businesses and decide to exit, they really having a sound plan and thinking about that. I've been fortunate too to actually meet some really great people that help people understand that. You know, I don't deal with that as far as that part of it, but I think for a lot of people, it's probably well worth the investment of trying, talking to people about that.
Yeah,
But
definitely.
we're kind of getting off on there, but I just wanted to say, because it is just, you're with the taxes and this other thing, but, thanks so much, Spencer, for being here today. I mean, I'm glad that I was able to finally get you on and we talk about the taxes, because this is something that, A, it happens every year. B, there's one-time life events and other things that people should be reaching out, communicating regularly with their tax professionals, and really understanding what they can do and how they need to, and what they need to do with their tax professionals to reduce their overall taxes or just keep them appropriate. So,
Yeah, it's been a pleasure, Tammy.
all right.
Great.
Well, how do people get a hold of you, Spencer? What's the best way?
If they want to get a hold of me, easiest way is through email.
Okay.
I'd be more than willing to give out my phone number, but I think most people are this way. I don't pick up a number I don't recognize, so it's easier for someone to repeat.
Yeah.
I don't know if I
can share it in the show comments too. We'll do that.
My email.
And then they can find you on LinkedIn too. It's Spencer Strickland.
They can find me on LinkedIn.
Yep.
They can go to my website, grantcocpa.com.
Okay, grantcocpa.com. Awesome. Well, and they can get there and hit you with an email from the website and reach out to you there if they've got some tax things they want to talk about. So thanks so much, Spencer Strickland, for being here today. We're talking about tax strategies for business owners and other high net worth people. Thanks everyone for listening today. We will be back again on Thursday.
Thanks, David.
You bet.